Hey gang, this is Greg Barron, aka the Professor. We're going to talk about financial modeling in one specific asset class called build to rent. This build to rent phenomena has really swept the country in the last couple of years post-pandemic. We still see some activity. As a matter of fact, our company has several build to rent communities that we're designing. I've got one that I want to show you that I particularly looked at recently. I did some modeling on it financially to see if it would pass the muster for something that we would be interested in. I'm going to talk to you a little bit about some definitions of it, give you some news articles that are current. Then I'm going to jump into ProformaPlus, which is a groundbreaking software which is specifically for the real estate industry that does financial modeling efficiently and very quick. But first, let me give you some background via some articles that we've uncovered recently that gives you an example of what really build to rent is all about. So as you can see from the article from Property Shark, build to rent homes are created specifically to be professionally managed communities, often providing residential experience with upscale amenities, much like a typical apartment complex that is targeted at young professionals in urban areas. Gen Z and millennials who prefer to rent rather than owning big assets. So let's talk about this small project that I was just evaluating. Basically, we've got 8 lots, anywhere from $75,000 to $85,000 a piece, in a gated community in Central Texas. It's the last build out, and it's a transitional property. And what I wanted to basically find out is if we developed all of these as a build to rent and ultimately exited in about 5 years, what would the original investment look like? And more importantly, what would the exit look like as a return on our investment? So before I show you a loaded Proforma in ProformaPlus, I want to talk to you about 4 major changes in lending covenants that we're going to center on today that we can evaluate. And these are going to determine whether we get a thumbs up or a thumbs down at the end of the day. So there's 4 basic things that loan covenants are demanding these days. Number one, we're no longer in the days of 25% down on a commercial investment. We're anywhere from 35 to 50% down on most deals that we're looking at. So in talking to my bankers and getting term sheets, there's 4 major issues that I'm having to deal with in our new developments. Number one, and most importantly, is our increased equity contribution. Gone are the days when 25% was the typical equity investment that we have. Now we're looking at a minimum of 35, in most cases, upwards of 50% as our initial equity contribution. Number 2, they're asking for potential increased reserve requirements that we have to add. Number 3, our debt service coverage ratio has to be at least 1.3 and above. I'll explain that a little bit more as we get into the software. Number 4, I see a lot of banks are asking for more personal guarantees and less non-recourse loans in commercial real estate. So let's talk about those loan covenants just a little bit. I had the privilege of being a director of a public bank for a dozen years, and I was also on the loan committee for those banks that actually looked at hundreds of these, if not 1,000 or more of these types of loans. So I don't want to take it for granted that you know what some of these terms are. I'm assuming that you know what equity is. I'm assuming that you know what additional reserves is. But let's talk about what debt service coverage ratio is, and then I'm going to pop into the software and I'll show you specifically how data inputs and how having a really good financial modeling tool can show you prior to taking it to the bank whether it's going to meet the mustard of their approval or not. Also, during these economic times, I have heard from several capital companies, if you don't have great financial modeling, we're not even going to look at the deal. So as any good researcher does, I input DSCR, or debt service coverage ratio, into ChatGPT, and this is a definition that came out. Debt service coverage ratio is a financial metric used to assess a company's ability to generate enough income and to cover its debt obligations, particularly interest and principal payments. It's commonly used by lenders, creditors, and investors to evaluate the risk associated with the company's debt. And here's the simple formula. It's net operating income divided by the debt service. As you can see, it's a financial metric used to assess a company's ability to generate enough income to cover its debt obligation. I found that it's most used by lenders, but it's a good indication to me as I'm looking at my modeling software whether I'm even going to begin to meet the coverage ratio that's required before I take my deal to the bank or before I present it to a capital partner. It's a real simple formula. Take the net operating income and divide it by the total debt service. So this video is only a macro level of a build to rent. I've already input most of the information needed. So the only thing I'm going to do today as far as the build to rent is I'm going to change a couple of data points in here to show you if this meets the loan covenants that are present with today's lenders and capital providers. First off, let me show you this deal 2 years ago when we first started evaluating it. As you can see from the input screen, we first started with an interest rate of 5% on the construction loan and a loan to cost ratio of 70% or 30% equity down. We figured our construction loan at 4.5% at a loan term of 5 years with a 20-year amortization period. This was about a $3 million development. And as we look at our building income here, we projected 2,200 square foot of rentable units at an average rate of $1.80 a foot, or about $3,960 per unit. Now this will make sense in just a second when I go back into the Proforma. Now 2 years ago when we started looking at this and we ran our debt service coverage ratios, we had a ratio of anywhere from 1.39 to 1.47. Actually, it was a decent deal at that time. Over here, from an internal rate of return upon exit, we had an internal rate of return of anywhere from 21 to 38.8%. Now remember those numbers along with the debt service. Now fast forward to 2023, entering 2024, and we're looking at this deal again based upon the new loan covenants. And I'm curious, is it going to be a thumbs up or a thumbs down now that we're evaluating it? The only couple of things I'm going to do today is I'm going to manipulate my equity, and then I'm going to manipulate my interest rate, and then I'm going to revisit my building income to see if I can still get the same rent in today's market. So I've already indicated that we've got to change our equity that we're going to invest. So let's change this from 70% to a 60% loan to cost. Obviously, I'm going to have to change my interest rate from 5% to now we're looking at a 8% rate on our construction loan. On my senior debt or my long-term mortgage, again, I'm moving from 4.5%, and I'm going to go ahead and use 8%, which is the term sheets I'm getting today. Still got a 5-year loan term, and then I'm going to recalc those just with that information to see where my new debt service coverage is. And I think you'll find this pretty interesting, all things being equal, without changing my building income. And if I tab down to here now, look what's happened to my debt service coverage ratio. It's gone down to 120 to 127 on average. Banks are not lending much, if anything at all, less than a 1.3. In other words, your net operating income is 30% more than the debt that you're having to service. So as we see here now, this project so far is a thumbs down. So far I'm going to have a little trouble getting this through a loan committee with these kind of debt service coverage ratios. So what are my options? Well, the only option right now is to see is what amount of income is going to change to effectively produce incomes to get my ratios up just to get a loan on the development. So once again, let's pop into the software to see what happens if we raise our building income and find out exactly what is it going to take to make this a viable deal, both at the lending level and to satisfy my return on investment. So it's real simple in this software. I just simply go back into my building income. I push the edit button, and then I increase my rate of income on the 2,200 square foot for each unit to what I think is a maximum amount that I can get in today's dollars, which is a $1.85 a square foot. I hit the save button. It automatically populates my new income. And then I go back into my project center. I go ahead and recalc. I go back down to my debt service coverage ratio and find out that raising it to that amount barely meets lending criteria. But it works. The only problem is I can't get a $1.85 out of my tenants. So in effect, the deal is a marginal deal, and I'm going to have to pass the project's a thumbs down. But the good news is, I want you to know that you can see, even though this deal is not going to work for me right now, there are other deals that even with the interest rate structure the way they are, there still are some out there that can be pushed over and successful to me as a developer and as an investor. I just have to continue to plow some hard ground like a lot of you out there are to find projects that meet my own individual criteria and, more importantly, the lending criteria that the capital markets and the banks are requiring. Check back with me next week. We're going to look at a self-storage facility going through the same criteria that just might fit our development requirements. Until next time, remember my formula: educate, evaluate, and then execute.